Welcome to the New York section of SME, the Society of Mining, Metallurgy, and Exploration, an international society of AIME of more than 13,000 professionals serving the minerals industry in more than 100 countries. Today is December 8th, 2020. Thank you for attending NYSME's virtual symposium titled Strengthening Critical Minerals Supply Chains in North America, featuring the key role of Quebec. This panel's discussion is titled, What is Ahead for the Critical Minerals Sector in North America? The panel's moderator is James Clark, Principal Consultant at Benchmark Mineral Intelligence. The panel will now begin.
Hi, good afternoon. Today we're running a panel on, as part of the NYSME event, in strengthening the critical raw material supply chain in North America. And what we want to discuss now is, after seeing all the previous sessions, what's ahead for the critical mineral sector in North America, how the value chain looks, how pricing and engineering is going to interplay on that, and how we see that developing going forward. So on the panel we've got today, we've got a really good mix of everything. We've got from the engineering side, from the project development side, from finance, and from operational assets. So we'll do an introduction of the five of us now. My name's James Clark. I'm a principal consultant with Benchmark Minerals. So Benchmark, for those that don't know, we do consulting for lithium-ion, consulting and market reports for lithium-ion battery raw materials, the supply chain, cathode, anodes, and future trends. My background is I'm a geo and previously worked for mining companies Glencore and Xstrata and in project finance. So now I'll hand it on to Sean Cleary, the Chairman and CEO of BlackRock Metals, just to give a quick intro on himself.
Hi, I'm Sean Cleary. As James mentioned, I'm the Chairman and CEO of BlackRock Metals. BlackRock Metals is developing a vanadium, titanium, and iron mine and metallurgical facility in Quebec. I believe over the next few years, we're going to see the critical minerals discussion will start to broaden to other minerals. And I think vanadium is going to be one of those very topical discussion points. And happy to be here today.
Thanks, Sean. And John Pfahl from SRK.
Yeah, thanks, James. So I'm John Pfahl. I've got a background in mining engineering, but I've spent most of my career in the investment side of the business. So I work with SRK Consulting, and I do an advisory role with whether it's mining companies, investors, downstream users of mined products, with a fairly heavy focus on critical minerals over the last 5 to 10 years. So happy to be here.
Cool. Thank you very much, John. Kiril Mugerman.
Thanks, James. So yes, President Kiril Mugerman, President CEO of Geomega Resources and Kintavar Exploration. So my background is a geologist, worked in the field for goldfields exploration, then worked on the sell side as a mining analyst, special focus on industrial and critical metals. Since 2015, I've been running Geomega Resources, a rare earth exploration company that I've gradually converted towards a processing technologies company for rare earths and other critical metals, all around the sustainable nature or sustainable processing technologies. And Kintavar Exploration is a more traditional copper exploration company, so a mixture of both. And that's it. Thank you.
Okay, thanks, Kiril. And Richard Reeves, or Rick Reeves from Northcott.
Yeah, thank you, James. I'm Rick Reeves. I'm with Northcott Capital. I started out in the industry, I guess it would probably be close to 35 years ago now. And I started out on the production side in the coal industry, and I'm a mining engineer by trade. But then after being in the industry for about 10 years, I went into the finance side by getting an MBA from the University of Chicago, and with the intention of going back into the mining industry, but ended up as a banker of all things. And so I worked in banking and investment banking for various banks, and through about 2016, and then I joined up with the team at Northcott Capital, and our focus is project finance and capital advisory to mining companies. We focus more on debt than equity. We do have some links into the equity markets, but our strong focus is really debt. And thank you for inviting me, and I'm happy to be a part of the panel.
Thank you very much, Rick. So, gents, thank you again for the introductions. What we'll do now is we're going to talk through a few topics as a round table. I'll go through it as we go. If you want to jump in and add anything, feel free. If you think I've missed anything, go ahead and jump in. So the first thing we wanted to do was looking at the critical minerals value chain and having discussions before the call, is to look at it holistically from the mine all the way to where that's used. So you have obviously the first step is digging it up, and eventually through 5 or 6 other steps, it's going to go into an automobile or a defense application or something else. So for us, and that's really the important thing, it's how many steps there are when you're looking at critical mineral supply chain to take it from, say, if we use flake graphite as an example for anodes in lithium-ion batteries, take flake graphite to upgrade it, to spheritize it, to coat it, to anodes. At the moment today, even if you had a flake graphite mine in the US, you wouldn't be the only step you could do would be the initial one. So gents, just your thoughts on that kind of from other industries in the battery space and how the processing sides and that concentration of intellectual property will help develop or could help develop this critical mineral supply chain if implemented correctly. I know, I guess perhaps Sean, you'd like to start?
Something along the lines of what we have in the steel industry for North America. And that at the end of the day is going to add security or a feeling of security, I think, so long as it can be done in an economic way.
Yeah, thanks, Sean. So it's certainly from when you speak to people on the mining side, actually mining in and of itself is breaking big rocks into smaller rocks. It's the processing where you really add value. And I think probably John, Kiril, and Rick, you'll speak to it when projects tend to fall over or tend to struggle, is often on the processing side. I don't know, chaps, you got any more thoughts on that? And probably also coming back to it, how the recycling would impact that going forward.
I'll jump in for a second. I definitely would second that that's where the projects usually fall apart is in processing. It's the only project I ever saw that we actually financed when I was in the banking side that really came unstuck due to geology, and it didn't totally become unstuck. It just had some serious cash flow issues until they got to understanding it was actually the Stillwater mine up in Montana, and that's because the company didn't really fully understand the dynamics of the ore body until they got into it. And once they began to understand it, then they were able to profitably mine it.
Because there was one in Botswana like that, right? They thought it was a copper sulfide and turned out to be an oxide.
Right, and it wasn't anything. The problem with Stillwater was not that the ore body was a different chemistry, but that when they actually explored the ore body, they thought that the distribution of the ore was relatively consistent through the ore body. And in fact, it was not. Actually, the ore is contained in nodules. And so you have to kind of find those nodules underground and then extract them. But anyway, back to the processing. Normally, yes, processing is, I think, the place where most projects actually make or break themselves, because that's and it is where truly the value is added. I mean, that's the fact is that that's definitely it's the technology intensive part of the process. It's the part of the process that often requires a certain amount of trial and error to get to where to get the thing to actually work entirely. And so it is the more difficult side, and it is also the value chain. And I think that, that's, you see that, and countries recognize that globally. For example, even though it may not be the best way to approach it, in Indonesia, for example, the push by the government is to get the processing onshore. Now, the way they're attempting to do that may or may not be effective, but the goal is definitely a legitimate goal. And you've seen that in other countries too, where they're a lot of their minerals just produced as concentrate and shipped. And I think exactly as we were talking, before, that's a major goal of Investment Quebec, is to bring that part of the value chain into Canada and into Quebec, because that's a tremendous influx of jobs and revenue and wealth, and it's taking it's giving you the best multiplier to the resource you have. And that's really what, when you think about mining, is an interesting business, because it's a business that actually adds actually capital, in a sense, in the form of ore into your economy. And so when you the more you process it, the more you refine it in your own economy, the bigger Keynesian multiplier you get off that capital you add.
Yeah, I just wanted to sort of concur with Rick's point there on the processing adding the most value. This, I think, has now been identified, and it's something in Quebec that there's a lot of focus on. I think when they started the Plan Nord a number of years ago, it was really just about the extraction and developing and supporting the mining industry. And that's really developed over the last couple of years into a focus on downstream processing as well. And when we look at the list of critical minerals, you know, what jumps out is that in a number of cases, there are not many sources of these minerals. And I mean, I think that's one of the reasons why this list has been developed overall. And so where we have good deposits in North America, they should be looked at for development. And we were discussing earlier about, you know, the risk of development of mining operations in the North American context, and some of the challenges that we have. But where a project is low cost, tier one cost potential producer, and it's got the social acceptability, it's got, you know, agreements with First Nations, it's got the local, you know, support of the local communities. And it's a, you know, in many cases, a lot of these new projects are very environmentally friendly. You know, so if it ticks the boxes on these are projects that should be financed and developed to build an integrated supply chain. In a large number of cases, unfortunately, I think in North America, and James is probably going to touch on this, the history has not been that good when it comes to developing these mines, and there's a lot, you know, a lot of lessons to be learned from what's gone on in the last 20 years within North American mining development.
Yeah, and I think Kiril can probably, he's more at the sharp end of this, but it's also a lot of these minerals, when you look at critical minerals, the reason they're critical now is they haven't been fantastically economic for the past 20 or 30 years. So you look at California was one of the biggest producers of rare earths, but Mountain Pass shut because it was uneconomic. It's recently reopened, but geological shortage can be a function of two things. It's a function of A, it not being there, or two, that no one's really drilled for it. And you see this in lithium and graphite because they don't have the history that copper and nickel have of drill holes going down. So I guess, Kiril, you'd probably be very well placed to speak to this.
Yeah, no, absolutely. I think rare earths, for example, is a great example. I think 10, 15 years ago, when the junior market started looking for rare earth projects, they realized there were so many of them, right? So it's not a question of finding them and how rare they are. And then everybody understood the problem is in the extraction process. So here we are clearly looking at the early stages of the value chain. Then when people started doing the metallurgy to extract them, then the next thing was, okay, fine, I can make my rare earth concentrate, but if I'm shipping all my rare earth concentrate to China, then what is the advantage? Am I helping in bringing the value chain to North America, to Europe, or I'm actually helping the Chinese cause, and I'm bringing more concentrates to China, and China starts dominating more and more the downstream, the value chain. And going all the way down to the recycling section of it, if we think of it from, let's say the world is starting to catch up and understanding the processing and setting up small solvent extraction plants outside of China, now we are starting to look at recycling, but look at what China's been doing. It's been almost 10 years that China has been developing the rare earth recycling sector, and they are ahead of everybody else again. So and we are missing those steps in that value chain in rare earths. And James, you probably can comment on the on the graphite section, how we are missing those steps as well. So putting together the entire value chain is very important, and finding the deposits is really not the is the most important portion. It's important to find the good deposits, but there is abundancy of those deposits.
I think probably also a point to mention is that it's, when you look at critical minerals supply, a lot of this can be sourced globally. So you can get locked out of one market, but it's unlikely you'll be locked out globally. And you can take historical precedents from the Cold War for this. So business was still done, commodities were still sold between countries. It was rare that that would get completely blocked. So, and we see this, and John, you can probably speak to it when you're looking at joining those dots. And as Kiril mentioned, graphite is a great example of this. So flake graphite in the US at the moment, and the developers are starting to recognize this, that even if you mined flake graphite now in the US for use in battery anode, you would have to ship that to China to be processed. The same would be true, aside from a couple of BASF facilities in Michigan and Ohio. If you had nickel, cobalt, and lithium in the US today, you can't make cathode. There's no cathode plants. And it's looking at the lithium side with Albemarle and Livent, they take in most of their lithium raw materials externally and process that within the US. And they're two very, very strong companies in that. So probably, John, I don't know if you have anything to add on that, being on the SRK consulting side, because this must be quite a large portion of your business at the moment, looking at how you do that and how you do that economically.
Yeah, absolutely. So, you know, it's interesting. You've got a full supply chain. You've got a lot of steps in it, and you can't just take one piece of it. So you can have a great deposit, and if all you want to do is develop that deposit and make some money off of it, that's one thing. And that might be a good way to leverage into building a supply chain. So, you know, Mountain Pass is a great example of that, where they have a really strong rare earth deposit, and they can economically produce concentrate and ship it off. You could leverage that eventually, build processing facilities to separate those rare earths and develop out the full supply chain. Or you can go the other way around and start the top down, like taking a Tesla, for example, which is using the batteries and working with a Livent or an Albemarle that has that processing technology to get the lithium and filling in the gaps in the supply chain, whether it's the precursor, the cathode, or the sourcing of the lithium itself. But I think that you need to look at it both from the top down and the bottom up and find, where do you have the strengths? Do you have a good deposit that you can build off of and leverage to start that supply chain? Or, you know, do you take the other way around and start at the top and work your way down through processing? You know, and it's key. Just building a processing facility isn't going to do any good if you don't have material to source. So again, rare earths, for example, if you want to build a heavy rare earth separation plant in the US, that seems like a great idea, but you need to be able to actually buy heavy rare earth concentrate, and where are you going to get that? So, you know, you have to take into account both the top and the bottom of the supply chain when you're looking at it, and make sure that you've got a plan to develop, whether it's the raw material supply or the downstream processing, that gets you that full supply.
Thank you very much, John. So yeah, as we've kind of gone through that, it's a case when you're looking at building out the critical minerals supply chain that not all economics or not all deposits are economic on the mining sides, and obviously not all processing routes either. So gents, more wanted to get your opinion on where you see, because governments are increasingly looking to get into this. So US government wants to look into this, as we've discussed, Quebec wants to promote this industry. When you're looking at promoting the critical minerals supply chain, which bits you would look at? Because to my mind, one thing you're very strong at in NAFTA, so US, Mexico, and Canada, is on intellectual property and funding it. So the US government, for example, has SBIR, which funds a lot of, via the Department of Defense and Department of Energy, a lot of the new battery technology, which is then licensed out to LG Chem, companies in South Korea, Japan, and China, which actually produce these cells. So gents, I don't know, Sean, perhaps if you want to go first as to how you.
Yeah, well, I think, you know, developing a project, first of all, as was mentioned earlier, the deposit has to be a tier one economic situation that adds a lot of value to the local community. And as a developer, the development in today's context has to be done from a grassroots level. You can't show up and say, we're going to develop a project and try and go forward with engineering and environmental permitting and ignore the local stakeholders. And that's kind of a cliche almost, because you have to do more than even just that. And at BlackRock Metals, the company that I run, that's what we've done. And we've successfully permitted, and we're basically shovel ready on a mine and a metallurgical plant to produce vanadium, titanium, and some iron products. And we have agreements in place with all the First Nation groups, et cetera. And this takes a tremendous amount of time, energy, money, and really the will to do it, and expertise of teams. And so one of the things we talked about earlier was, it's difficult for juniors, and especially public junior companies that are listed on the TSX or the TSXV, to be able to do this, because they're constrained not just with capital, but the scrutiny of their investor group and the fact that they tend to have multiple projects on the go. And so how we approach this, and certainly from a BlackRock Metals perspective, we've done it differently. We're a private company and we're privately funded, and we're in partnership with Quebec government. And so I think that approach, the approach to development has to be looked at in order to actually take potentially economic deposits and build them into real mining projects. And the recent history on this is not very good. When you look at vanadium in particular, the world is really sourcing vanadium from a couple of countries where their interests aren't necessarily aligned with the interests of North America.
But also South Africa as well, right, Sean?
South Africa, but to a lesser extent, 80% is really coming from Russia and China in terms of tonnage. So, there's issues there. There's real supply constraint issues, and the South African supply has been intermittent at times. And there's a few other smaller players in the industry as well that have been somewhat intermittent. So the development of this is the way we see it, very critical for the critical minerals development and having an integrated supply chain in North America. And I'm sure that there's people on this panel that maybe don't exactly agree with that point of view.
I guess it depends. I mean, vanadium it's always difficult being in these industries which were set up, which are kind of interchangeable products as well, with niobium coming in and being swapped out, which you see in Europe, and the Brazilians managing that price of niobium to stay low and flat. And there's probably also something Kiril can definitely talk about on the rare earth side, is demand destruction when you get these price pops. So probably actually, Sean, from that point, it's probably good, because Cyril's been kind of at the sharp end of this, looking at the recycling processing and on the kind of that feedback loop with prices. So with the economics and with developing the supply chain.
Yeah, I guess the way we've looked at it is to develop projects where we minimize the waste, we maximize the yield, and we have more than one revenue stream. And so I think in these sort of lower volume minerals, and I would categorize vanadium in that, it's very, very important to have a second or third revenue stream coming out of these projects, because otherwise they just will not stand the test of time in terms of price troughs. And I think in order to actually have a project that can get financed, you have to be in the tier one lowest cost producer.
Yeah, cool. Okay, thank you very much, Sean. Yeah, just kind of on that, handing over to Kiril now. Sure. Just to understand, particularly when we're talking about how governments can work with the miners, and I know you've been kind of at the sharp end of this, developing tech on the recycling side and the processing things, and also with rare earths. So just your thoughts on.
James, our first approach when we look at any project is it has to be competitive, economic at the lowest level of the prices. And let's say it's hard to say what is the bottom, right? Nobody can call those perfectly, but there is a pretty good idea where it is in general, and we need to make sure projects are economical at those bottoms. Once we see there is potential with this, then the next step is the processing technology. And can you put around a process that will be economic at those low pricing and will be more sustainable than the traditional process that is being used right now, whether it's China, Russia, or whatever is the country. And of course, the reason behind all this is whenever we do see a price spike, and rare earths is a good example right now. The last 6 weeks, we have seen an unbelievable growth in neodymium, praseodymium, dysprosium, terbium prices. In general, it's been a pretty good year for rare earths, but really that spike of those 30 to 45 days is what causes the biggest uncertainty in those critical metals. An end user, if he can look at substitution, he will always look specifically for two reasons. One, the lack of options in terms of where he buying it, so that lack of diversity of supply. And two is that unpredictability of supply. I mean, a car manufacturer, if you tell him that his motor will have to increase 30% in price because in 4 years from now, he doesn't want to know anything about it.
It's true.
He wants very stable prices.
Yeah, it's a very big issue, particularly on the lithium-ion supply chain as well. That you have the cathodes, the nickel, copper, and the lithium is a floating price within that battery cell, and you can't. If nickel price pops 20%, you can't pop 20% on the price of the car.
Exactly. It's very hard for those end users. And, so because of this in the rare space, which the main usage is the magnet that goes into the motor of the electric vehicle. And another main industry in that space is the wind power.
Mm-hmm.
And the only reason that many companies still have not switched to a permanent magnet motor or rotor, better said, it's because they are afraid of those spikes. And I would say the rule of thumb in the rare space has been that for every doubling of the price, you lose permanently 10% of the demand. And that demand is not coming back. And it's because they either shifted to another metal, another technology, another way of substituting it. So it's really destructive to see those price increases. And that's why we need mines. If we are developing the entire supply chain, we need mines, processes, and the downstream conversion to metal to magnet or to cathode to be able to do it at those current prices.
And how do you see, gents, probably when we're talking about the processing sides, we've covered the mining side and the smaller bits, but there's obviously a significant IP and significant process investment to onshore that into the critical mineral supply chain in the US. So probably going back to you, Rick, from the finance side, and you, John, from kind of finance/consulting, how do you see that being funded and developed going forward? So the US obviously has a pretty strong plan to develop IP in certain key sectors, usually driven by defense, Department of Energy, or particular goals on the government side. But how private capital is going to play a role in that, in which you do see, certainly in the lithium industry, with firms like Lilac looking at direct lithium extraction, with firms like Urbix looking at processing graphite within that. And quite a lot of that spun out of the tech scene in California with chemical engineers and the VC firms getting together to drive this. I don't know, John or Rick, if you have any thoughts on that side of things.
Yeah, sure, I can jump in there. So, I mean, absolutely, the US really is a technology leader in the world. Whether it's mineral processing, downstream technology, whichever part of it, the US definitely plays a big part in that. I think that what we've got to remember, even when it comes to critical supply chains, is Western business is driven by economics. We don't subsidize our businesses. And so whether it's the mine or the processing facility or anything else, it does have to make money. It has to be a successful business. And so I think that that's really the challenge, is making sure, if we're building a processing facility, that we have the ability to source raw materials to operate that processing facility competitively. So, that goes into the integration supply chain and whether you have a local deposit or you have to go offshore somewhere to let's call it a friendly country to source that. But one way or the other, you do have to have an economic project. And I think that's key is right now, we don't pay significant premiums for, let's call it local supply or safe supply. Right now, it's all being driven by the economics of the downstream, which is keeping costs as low as possible. And that's a challenge to work through in that we're not going to pay a premium for it. So we've got to figure out a better way to do it, to be able to do it for cheaper, or to at least be able to be competitive, to be able to get that financing, to be able to develop those projects.
And I think you can kind of see that in the auto industry and other industries in the US at the moment. So particularly, all of us are probably working on a computer that's largely built with Chinese components and Chinese circuitry, probably designed in the US. And the same with auto, you're buying different bits from Germany and everywhere else. So yeah, I don't know, Rick, if you've got any thoughts on that.
I think you have to look at it from two perspectives. One, I think you definitely have to have an economic project, but then you have to say, well, what makes an economic project? And that gets to that gets to the demand side for the product. And this is a particular issue in the U.S. for some of these battery minerals, because while there's definitely demand in the renewable space for wind energy to attempt to develop in the areas where that resource is significant, and there are numerous areas in the U.S. where there is a significant resource. In the automotive industry, I think it's a bit more questionable for the U.S. And the reason is because it gets back to, in the U.S., unless we have enough of a sea change in governance, which I'm not sure we're going to have, because I think although we clearly will have a change in president, I'm not sure that our Congress will change that significantly. It's kind of up in the air for right now. The fact is you then get back to, well, is this electric vehicle really competitive to the average consumer in the U.S. with an internal combustion vehicle? And so that's going to be an issue here. Because the fact of the matter is internal combustion technology happens to fit well to a lot of U.S. consumers of vehicles, because they tend to often drive. In the U.S., we actually drive the typical person drives their automobile twice as many miles as a person does in other countries, and that's a significant issue because it means that they will demand strong range, they'll demand ease of charging, they'll demand ease of everything, and it's going to have to be truly competitive. It has to get to a point where it's just like for an IC, an internal combustion car. When you get down to a quarter tank of fuel, you see a gas station, you fill it, and that is going to be a big issue on it. That said, there will be parts of the U.S. that will adopt to, and obviously Tesla is selling cars, and I think that for people who live in the more urban areas of the country, that that will be more where the adoption is. So that's the first piece. And then the second piece is, of course, as everybody's talked about, where is it economic to actually develop a processing facility in the U.S.? And that gets to and then furthermore, can you get the environmental approvals and the social license to do it? And here, that can be very difficult depending on the jurisdiction. It varies widely across the country.
That's probably not a bad parallel to draw there, speaking back to internal combustion engines and the oil industry, right? So if you're looking at US, oil was always very critical for the US economy. Production obviously dropped before they brought on horizontal drilling and fracking.
Yes.
And they were always able to source that, but not necessarily from politically stable environments or with various foreign policy decisions, things that became unstable political environments. So it's probably not a bad proxy for it. And you see, kind of just from outside driving it, that when, for example, when the oil price popped from about 20 or 30 to 60, it made the Alberta oil shales economic. When you had those prolonged oil prices, that gave enough money to develop the hydraulic fracking technology, which dropped the oil prices through the floor in the US and gave a lot of gas supply. I know from having particular experience on the team, having seen those sort of cycles, whether you think that would also apply to critical minerals as well. that it tends to be when you get there's a certain push or a certain sea change in this that starts to spur that?
I can bring an example, but it's from the opposite side, going in the opposite direction.
Yeah,
In
go for
rare
it.
earth elements and in the permanent magnets, specifically the ones that are going into the electric vehicle motor, temperature is very important. So you need to put a lot of dysprosium and terbium to make sure it can resist the high temperatures that form within our motors. Until the price increase of 2012, a lot of dysprosium was included. It almost was mixed evenly throughout the entire magnet. Because of the price increases, we have seen the development of a new technology called grain boundary diffraction. It wasn't that new, but it wasn't used as much. And when they started using the grain boundary diffusion, they dropped the dysprosium terbium usage from 4, 5, 8% down to 1% and less. That actually destroyed the demand. But those changes like this, and as I said, this is more of a negative technology application for the critical metals. But similar changes, and again, improvements in the usage of the magnets in the motors. And I've seen so many different configurations for the motors, how the magnets are positioned, and that's all improving and going to increase the usage in those electric vehicles.
I guess you can almost draw a parallel as well to cobalt within the EVs. So since the price of that popped back in 2018, relatively high value, relatively small volume commodity, prices tripled and then they come back. And you see that across the minor metal space. And suddenly you get cobalt thrifted out of the battery. So instead of it being an equal ratio to nickel in NCM 111, it's 8-1-1. So 1 part cobalt to 8 parts nickel. So it makes sense. It's that financial incentive to drive technological development, I think, Kiril, that you're referring to. And that probably would also see in internal combustion car engines with your miles per gallon or liters per 100 kilometer, just making sure I cover both the metric and the imperial side, that actually makes that change. It kind of, I guess, probably slightly going off that theme a little bit. When you're looking at the US, and particularly probably this is the finance and development question, links back a little bit to what Sean was saying, with the renewable energy development and how that links into critical mineral supply chains, that they're not indistinct. So as Kiril was mentioning, using these magnets in wind turbines, when you're looking for the auto producers, a key part of the decisions they're making, one, because their investors demand it, but secondly, for financial reasons with regards to their carbon offset. And you see in the tech companies as well that everything is moving towards this renewable energy side. And whether in your operational experience, kind of Rick, John, Sean, or Kiril, that this would be and is gradually becoming more of a positive for North America as that energy balance shifts.
I guess we've, if I can, I'll just add that we've seen a tremendous amount of focus on life cycle analysis from suppliers as well as users of some of the different minerals that we deal with, and specifically in the case of vanadium. And I think, I think this whole idea of ESG, environmental, social acceptability and governance, and life cycle analysis in terms of the carbon footprint or the environmental footprint of the product from throughout the supply chain, right back to the extractive source, mine, et cetera, is going to be more and more of a focus of large companies and institutional investors. I think we're going to see that going forward. And I know, like within our firm, we've really tried to develop a company that addresses this and that focuses on ticking all the boxes in terms of social acceptability, in terms of having like a virtually zero waste footprint. And, we have one of the projects that's going to have the lowest emissions in the world for this type of metallurgical complex. And that comes with a cost. And so you also need the investors willing to invest additional funds to be able to actually deliver that. And it's not clear that we're going to be able to actually garner any necessarily economic advantage in terms of profits from that investment. But we believe that from a market share perspective, this is the way to go. And I think that's going to be a huge issue going forward. I think it is an issue now, but it's just like on the verge of becoming a very large issue for the future.
Okay, thanks, Sean. And going on from that, probably one for Rick and John, and maybe Kiril as well, in terms of the financing of this critical mineral supply chain. Now, when you're looking at, assuming the equity finance is tucked away and you're looking at the debt portion or even the equity portion, that the ESG standards, and you see it particularly with development finance funds, so firms like Responsibility have significant amounts of capital to deploy in developing this. I know, Rick, you've been structuring debt in this sector for many years now. How you see this when you're financing the development of these particular projects with the renewables, with everything else? If that's something where, obviously with the US being a low risk jurisdiction, that it will make that debt financing or that equity financing that bit easier?
Well, the ESG element is important regardless of jurisdiction at this point in time. I mean, and the reason it's important from a financing perspective is that most financial institutions, in fact, virtually all of them, with just a few exceptions, are have signed on to the Equator Principles. And so as a result, they're loath to finance anything that doesn't have ESG, and they also perceive it as a major risk factor, particularly on the debt side, because if you don't have ESG, you don't have permitting, you don't have all that in place, you don't have a project, candidly. I mean, there's in fact, most lenders are not going to fund until they know the project's permitted. And the project won't be permitted without having, made it across the ESG hurdle and having gotten what I would call local acceptance by the people that are in the footprint of the project. So that's that almost is, it's like a prerequisite. That said, pardon?
Just thinking on the raw economic side, so I know it makes in the margin, so you always pay LIBOR plus. So in terms of the margin, right in thinking that historically, if it's ESG backed or environmental finance, it's often cheaper than the commercial rates necessarily. So from what you would get from a senior project finance bank, if you can hit the various responsible investment criteria to bring in investment to the supply chain. So for example, if you located a graphite processing operation, say make spherical and anode in the US, but you could prove through the life cycle analysis and everything else, you're gaining a significant environmental benefit in that. Would you see that affecting the economics by reducing the margin on the debt? Assuming it was a good project, assuming all other things being equal.
I think it only at the edges. I think the things that will, the things that really drive the margins on the debt are get back to the basic economics, and that is, first of all, the risk that it gets to really the things that the lender sees that they either can control or their customer can control. So at the end of the day, it really gets to, where are they on the cost curve? How much leverage is in this thing? I think those are going to always be the major factors, leverage versus cost curve versus the commodity itself. And then, I think that the main thing that having an environmentally, socially responsible fund in a deal does from the perspective of most lenders is it makes them comfortable that the project is less likely to get tripped up over some of this stuff. But the reality is on the debt side, there's really no incentive to take the risk of a project that can just, the thing about things like ESG and permitting is it's a binary risk.
Mhm.
You either have it and the project can operate, or you don't, and the project does not operate. So that is kind of a place where, honestly, I don't think lenders price
I think
accordingly.
that's right, Greg. I think you said it at the outset there where you said it's a prerequisite. So our experience is that it has not positively impacted the cost of debt or even the availability of debt. But it's a prerequisite that if you want to be able to develop a project, that you must have it.
But I do think it can help you on the equity side.
Yeah.
I think that it will open you up to other investors who have, there are investors who are developing criteria that they don't want to invest in things that they don't perceive as being socially responsible. And even though that may or may not be a primary factor for every investor, the fact of the matter is to the extent it changes, investment markets are like any other market of, it's just a supply and demand of capital. And at the end of the day, if there are certain elements of capital that are more likely to be there than not, then, that helps you on the equity side, and it kind of, in a sense, lowers your overall cost of the equity.
All right, thanks, Rick and Sean. John, I think you perhaps wanted to chip in with a point on that.
Yeah, I was going to say that Rick's absolutely right. The ESG side of things is not where your project is located. It's the company that's running it and their practices and how they manage and operate the project. And the banks are obviously going to check that and check it very thoroughly before they'll provide finance. So, it's less a where is the project located, it's how the project is run. And I think that we see that in the development of critical mineral supply chain is for a company like, say, an Albemarle, for example, that really is dominant in the lithium industry. They can operate in a place like Chile, or they can go to, if they wanted to, someplace like Argentina or something that may not be the US, but I don't think anyone would have any concerns that a company like that would be operating properly and be able to develop a socially and ethically sourced supply chain. And so I think that really comes down to who's running the project, who's developing it, more than anything else. There probably are some countries, Congo probably is a good example, where something like cobalt supply is going to be very difficult to build out. And that's because the big companies that you probably trust are less likely to work there. And most of the deposits that are still being developed are quite small that would fit a big company anyway.
And then also you get to those same countries, the reality is on the debt side, once you get to that level of political risk, most lenders will just say, we don't want to be there.
Yeah, it's fully understandable. I know ESG is everything I find is overlooked in project developing. When you read the reports, the ESG sections are often very light. And I think it's not just junior mining operators that have these issues. Any major mining company, ESG is your license to operate. When I was at Xstrata, we had a shutdown at one of the assets because the trucks weren't being covered and it was blowing dust on the local people's houses. Local government turned around and said, done, shut the road. So you're losing millions of dollars each day. And I think it's something the mining industry knows very well. And I think when you're in the communities where the mines operate, they know it very well. I also think miners outside of those markets, because miners really care where they're operating. That's the community that's directly important. Where your head office is, the community there is, it's not immaterial, but they're not the key people that you're developing that for. That's the investment community. So I'm just getting a nod up that it's probably time to start wrapping this up at the moment. So I kind of think from the conclusions that we've drawn from this, the key thing on the critical mineral side is to understand where, regardless of geography, where you have a strength or where your particular subset has a strength. So whether that is in the asset, in the particular energy mix that's used to do that, in the technology that you're using, and to leverage that to develop it going forward. So whether it's in the US, low political risk, high education standards, an increasingly green energy mix that will help this forward. I just wanted to kind of end up on, if we could just do a short closing statement really from everyone, just as your final thoughts to tie it up, and then we'll sign off from there. So, no, Sean, if you'd like to go first.
Yeah, I guess, final thoughts, I would say that, critical minerals, for infrastructure, transportation, technology, housing, it's impacting more and more of everyday life. And that's why it's important. That's why we should care. Even when you get into, and it wasn't something that we necessarily touched on, but, the whole crazy world of artificial intelligence, which is going to be descending on us, it's not going to function without many of these critical minerals. And I think at the end of the day, we have to remember that somebody has to find this stuff and then mine it and then convert it economically, with a modern processing facilities in an environmentally friendly way. You can't just run down the street to get a bucket of vanadium or, a skid of titanium. This is a critically important politically social element. It needs focus. It needs the focus of government. In my company, we're really blessed because we have the backing of the Quebec government, which I think is well ahead of the curve and instrumental in pushing this forward for their jurisdiction. And I just want to say thank you to all the other panelists today. It was a great chat. And James, thanks for organizing.
No worries. Thank you very much, Sean. I'm just going left to right now. So, Rick, any closing remarks?
Well, I think that at the end of the day, I think that all these projects will have to show economic scrutiny, and so I think that while we've talked a lot about ESG, and I think that's very important because it's a prerequisite to even getting started. I think then the other thing that will become very important is where does the project end up on the cost curve? And some of these minerals are really difficult because the fact, like cobalt, for example, is, there's so much byproduct production of that metal that it makes the cost curve very difficult. And then the other things that will raise into that for financeability, and this is something that we haven't really touched on that much, but the projections need to be realistic. The cost of development needs to be realistic, and these are things that I think it's going to push the industry probably more toward some of the more established players to being the people that actually do the development of some of these projects. In many cases, or if you have a junior player is developing it. They'll probably have an easier time developing it in conjunction with somebody that's established, or in the case of BlackRock, I think the fact that you've developed this relationship with the Quebec government will help. I think it gets back to a lot of the basics that will drive it, and as to whether or not these will be onshore, it would be nice to see it onshore, but it's going to depend a little bit on where the mines are, and also in North America, and also where the consumer is, and do they have good access to tidewater to bring the concentrate in if there's actual processing facilities. So it'll get back to a lot of those basic economic blocking and tackling, I suspect, too.
Thanks, Rick. Yeah, thanks. It comes back to the point actually we were discussing online with regards to the cost estimates about the NI 43-101 and how, when you speak to any professional investor, they know the margin of error that's going to be in that, and whether that's something the industry could help itself by doing, by tightening up some of those regulations to make those estimates a bit more realistic. Okay, John, any closing remarks?
Yeah, like everyone else, thanks. I really appreciate the opportunity to speak today. I think big picture for me, absolutely developing critical mineral supply chains and security of supply is important. And I think that the key that I see is that whether it's government or downstream consumers or whoever it is that's focused on this topic is really having a strategy and understanding the full supply chain, understanding that they do have a good deposit to leverage off of that really will be economic. And if you don't have one in your country, finding a friendly partner country that you can source that material, processing the intermediate steps, it all has to be thought out, and you can't just focus on one piece of it. You have to follow the entire supply chain, and you can't try and force a square peg in a round hole. You've got to work with what you have. Deposits you can't move. Technology you need experience, and making sure that you have the right partners to be able to pull that off is critical, because developing the wrong projects and backing the wrong projects can just backfire and set the industry back. And making sure to do it well is important.
Yeah, thanks, John. And that was actually something you saw in the mining industry across the boom, which you probably started out with, Rick will know this probably better numbers than I, but probably 10 or 15 mining project finance desks. By the time you got to 2013, there were 3 or 4 left, maybe, on the outside. So it's a serious issue. So the mining industry has a habit of shooting itself in the foot with regards to getting finance.
Unfortunately, you're right.
Yeah, I think some of the Standard Bank in South Africa and the rest, just you can only take so many hits, right? Okay, next, Kiril, any wrap up from your side, particularly kind of with your thoughts being closer to coalface on the recycling and tech development?
No, well, I'll focus on the ESG aspect a little bit. We are in the critical metals. They are being used for renewable energies. They are being used for the innovative technologies to make the world better and less greenhouse gases. So just the fact that we are in those critical materials, we already almost by default within ESG parameters, and it's very important that let's just say it's a new term. It still takes time to implement it properly. I think there is a lot of much more equity becoming available for projects from an ESG point of view, in equity investors who are looking for ESG projects. And until now, it's been very hard to select a junior that is ESG, because everybody can say they're ESG, but what does it mean specifically to a junior? So that's why a lot of equity has been going towards the large major companies. They have a huge budget for that. They have big sections in their financial statements, annual statements, outlining the entire ESG program. So as people learn how to adapt it and present it properly, more and more equity becomes available. And I think the Quebec government has done a great job with making sure that they're funding debt, equity, or grants are now focused you need to present how you are participating in an ESG initiative, or how does your project fit in there. So I think that would be my main comment here, that we are already in those critical metals, and we just need to make sure that the way we develop them are encompassing the ESG idea, because I think there is going to be many more opportunities to finance many of our projects, whether it's rare earths or any of the other ones, through the idea that we are trying to help and develop those new sustainable technologies and renewable energies.
Cool. Thank you very much, Kiril. Yeah, it's a nice closing statement. Actually, I guess all of us probably work in the mining industry. It would be something which would be nice to work in an industry where people see the benefit of it, because the mining industry historically has had a bit of a bad rep, and I think there's a lot of work to be done there, because it's vital. If you can't grow it as a plant, you've got to dig it out of a hole or pump it out of a well. Typically, there's not much else you can do. So it's got to be there, but it's something important to do the best job we can of making sure when you do bring it out, you bring out what's necessary, only what's necessary, and doing it in an environmentally responsible way. Okay, chaps, thank you all for the call. That's been a really interesting discussion today. I've actually learned a lot from the different participants about how their portion of the market chain works. I would say now, gents, will sign off. So thank you very, very much. You'll see on this last page now, you have the contact info for the speakers. So if you'd like to contact us, the email address is are at the points below. And that's probably it for today. Gentlemen, enjoy the rest of your week.
Thanks, James. Thanks, everyone else.
Thank you
Thanks,
very
Bye.
much, James. And also, we should probably, thank Sherman and Sterling for hosting us as well.
We very much should.